So let's say that the person that's selling the house today purchased that home for $400,000. And maybe they did that early 2020. And now the house is worth $600,000. Maybe when they purchased the house at $400,000, they put 20% down, which meant that they financed their loan amount was roughly $320,000. So let's call it a 4% interest rate that's tied to that $330,000 mortgage. The balance now is, I don't know, call it $310,000. When they go to sell the house, they're selling the mortgage with the house. So in this example, $310,000 loan balance, you would have to qualify. You would contact their lender, the servicer for their mortgage, and you would go through the pre-qualification process. So just like working with me or any other lender out there, your bank, your credit union, we can't help you in the assumption because we don't hold the note. Now, if we hold the note, we can help you. But in this scenario, let's assume we don't. That'd be a great way you could get in the fours, let's say it on a 30-year fixed rate. Here's the catch. Remember, I said that now that seller wants to sell the house because maybe the value on that house is $600,000. You have to be able to have the funds to go into closing with the difference between what the seller is selling the house for, so that sales price of $600,000, and the mortgage balance that you would be assuming in this scenario, $310,000. So now you've got to make up the discrepancy and you've got to be able to have funds to go into closing with those monies. That's the catch. That's the difficult part of assuming a very, very low interest rate in this market is just the difference of what the sales price is versus the loan balance. Now, in some cases, we have buyers out there that their intention was to put down 50% anyway, let's say. So if you're buying a $600,000 house, you're going to put down 50%, that's $300,000. You're assuming a $310,000 loan. That all day long is a great way to be able to get a rate in the fours if that seller has a loan that is assumable. Keep in mind that assumable mortgages are generally going to be government-backed mortgages such as FHA and VA. Generally, we do not see conventional home loans that are assumable